Welcome to Supernatural Stocks on Moneyweb with your host, the Finance Ghost. Your weekly fix of local and international news for investors and traders alike. These are the stories that really caught my eye in the past week. The banking sector is the financial backbone of the economy, and we saw various updates coming through in the past week. But to understand them properly, it is important to have a foundational knowledge of how banks actually make money. So that is where I am focusing in this podcast. And with the exception of Capitec, that has managed to become the best post-democracy business success story in South Africa, the banks have generally been a disappointment over most time horizons, and that is just in comparison to the local market index, let alone the global alternatives. Look, if you want to really, and I mean really depress yourself, then draw a chart of one of the local banks against a US alternative like JP Morgan, or even one of the lesser names that isn't held in quite the same regard as Jamie Dimon's empire. As such a comparison, especially in dollars, might ruin your entire day, I won't even hit you with those numbers. Suffice to say that I happily hold a couple of excellent US banks, and I don't have any long-term positions in local banks. But why is that? Well, above all else, banks need economic growth, and plenty of it. They need corporates, small businesses, and individuals to be borrowing money to buy assets. They need sticky deposits as a cheap source of funding. They love having clients with a more diverse set of financial needs, as this opens up other product opportunities like insurance or wealth management. It all comes down to driving the most important metric of all: return on equity. There are far too many corporate management teams that do not pay enough attention to return on capital metrics. In banks, where you theoretically have the most financially literate of all management teams, there is a deep understanding of the need to achieve adequate returns on capital that has been deployed into the market. Of course, having an understanding of return on equity and being able to achieve those targets are two different things. And it is well worth developing your understanding of the key drivers of return on equity and how the banks do well, or not, as the case may be. Let's look at the engine room of a bank. At their core, South African banks are quite simple beasts. They are traditional lending institutions, accepting deposits on one end and making loans out the other. This generates net interest income, or NII, with another important metric being net interest margin, or NIM, or NIM for that matter. This is almost like the gross profit that banks earn. How do you drive NII? Well, you increase the loans and advances that you have out there in the market. It's as simple as that. If you've lent out more money, you are earning more interest. This is why banks enjoy inflationary conditions that lead to corporates and individuals having to borrow more money. As assets become more expensive, balance sheets tend to grow and require more funding. But chasing interest revenue without a lucrative net interest margin, or NIM, is like growing a retailer that has poor gross profit. To maximize your net interest margin, a bank either needs to charge more, which is quite difficult due to the level of competition in the market, or reduce the cost of funding. Now, the cost of funding is a key differentiator among banks, as it really comes down to the quality of their deposit book. The cheapest possible source of funding for any bank is a lovely, sticky deposit rotting away somewhere in a current account. They pay practically zero interest to the holder of that deposit, but they can use that money to lend out to customers on the other side. And this is why banks with strong retail operations, especially among higher income consumers that aren't living hand to mouth, enjoy a structurally better net interest margin. And there's another important concept here in the engine room of a bank: the expansion of net interest margin as interest rates rise. When your home loan becomes 100 basis points more expensive, have you noticed that the deposit rate on your current account is still close to zero? The interest earned on the loan book rises at a much faster rate than the cost of funding for a bank that has the right funding mix. So an environment of structurally higher interest rates is positive for net interest margin. And when you combine this with the pressure that inflation puts on balance sheets and the demand for credit, you can see why there's a sweet spot in the interest rate cycle that is lucrative for the banks. Of course, when the rates start dropping, net interest margin goes the other way, and this is why you need to be cautious of banks when rate cuts start coming through. There's another ingredient in the recipe for core banking operations that varies considerably when you compare different banks, and that is the credit loss ratio. This speaks to the quality of the book, and it is balanced against the pricing on the loans. For example, a book with a higher mix of personal loans or unsecured debt will earn a higher net interest margin on a pre-provision basis, but this can easily be watered down or even destroyed by a credit loss ratio that might be out of control. Conversely, a bank with a very conservative strategy might look poor on a pre-provision basis due to the modest margins being earned, but it can look far better once you take into account those credit losses. In practice, banks look to achieve an appealing mix in their books. They don't really want too much exposure to any single asset class. The credit loss ratio is where you will find the effect of rates that have now moved too high to be in that sweet spot for banking. Although net interest margin may keep expanding as rates go up, the problem is that borrowers struggle to afford their debt and credit losses then become a problem. By the time you reach income net of provisions on a bank's income statement, you've worked your way through the engine room of how a bank generates income. This brings us neatly to the sprinkles on top, or the non-interest revenue. Although banks can generate a profit by focusing on NII, they are very unlikely to generate an appealing overall return on equity. To do that, they need to find ways to generate revenue without deploying capital. The best way to juice up a return on capital metric is always to add to the returns without adding to the capital. Numerator good, denominator bad. This is known as non-interest revenue. Basic examples of this would include the bank charges on your account. More advanced examples include investment banking deal origination fees, or advisory fees, or trading profits. What about the insurance business within a bank, or the fees generated in the wealth management operations? This is where the best banks really shine, because they find ways to grow non-interest revenue to become a major component of their total income. Although this can be quite lumpy, just think of trading and advisory fee income, the usefulness over time is beyond doubt. The US-based banks are experts in this stuff. They run excellent investment banking businesses and wealth management operations that generate eye-watering profits. The main reason I prefer offshore banks to local banks is that the local banks are actually just too dependent on traditional types of banking revenue, whereas their offshore counterparts are tapping into the deep pools of capital and earning fees accordingly. This brings us to the expenses on the balance sheet, and of course the question here is, the bankers earn how much? We must consider the efficiency ratio in the bank, which measures expenses as a percentage of income. A lower efficiency ratio is therefore better, even if that seems counterintuitive. This is where Capitec has historically been so strong in South Africa, as the bank was built with a focused model in mind and using new technology. The legacy systems and other issues in larger, older banks can create structural challenges in trying to bring the efficiency ratio down. And to be fair to the local banks, this is one area where some of the US banks falter. At a pure Wall Street player like Goldman Sachs, you'll always see analysts focusing on what they call comp, the US slang for compensation, or frankly what the bankers and traders are getting paid. When times are good in banking, the bonuses literally rain down from the sky. All the NIR in the world doesn't help if the efficiency ratio is through the roof because of internal bonuses. In more traditional banks, there are far less exotic costs to worry about. Just think about what retail branch networks cost and how digital banks can compete with that by coming in with a much lower cost model. This is why digital banks can enter the market with such simplistic offerings. They lose money for a long time as they reach scale, but the unit economics are strong. And when they work, investors tend to line up to support their growth story. At this stage, it looks like Time Bank within African Rainbow Capital may well enjoy that outcome. And finally on this podcast, we must cover the fact that capital comes at a cost. We've covered the important ingredients in the return on equity for a bank. But to achieve a premium valuation, a bank needs to generate a return on equity in excess of the cost of equity. This cost is grounded in financial theory and is based largely on the jurisdiction in which the bank operates. When you compare banks, always look at the price to book ratio when you're doing your valuations. It is a poor valuation metric in most industries, but it's a very good one in banking because the assets and liabilities on the balance sheet are almost all carried at fair value. So the book value is actually a pretty good approximation of the fair value of the net assets. If the bank can use those net assets to generate excess returns, and this is where that cost of equity comes in, I mean excess returns over and above the cost of equity, a premium valuation is justified. If not, then a discount to book value is practically guaranteed. So as you read banking earnings updates, always consider the major drivers of return on equity and how the bank is performing based on those metrics. And perhaps most of all at the moment, Remember that economic growth is the key ingredient for success. If growth is limited and rates start coming down, I think that the local banking sector is likely to underperform the market, and that is why currently I do not have any long-term positions in local banks. There's no such thing as an opportunity without risk, and these are merely my opinions on the stocks covered herein. Make sure that you do your own research, form your own views on the market when doing anything in your portfolio. Nothing in supernatural stocks should be taken as advice.